Level 1. The offer. You're 34 years old. You've spent the last 10 years working at an investment bank, building models, structuring credit deals, learning the machinery behind the financial system from the inside. One afternoon, the phone rings. It's the board of directors of a regional bank in your city, a mid-sized institution, founded 47 years ago, with 40 branches spread across the state and a rock-solid reputation among families and small business owners who've trusted it for generations. The current president is retiring, and they want you. You say yes the same day. In your head, running a bank is almost intuitive. People deposit money, the bank keeps it safe and charges a small fee for the service. It sounds simple, almost boring, compared to the fast pace of the investment bank you're leaving behind. You're about to find out that this picture is completely wrong, and you're going to learn it the hard way in less than a year. Level 2, the first lesson. On your second day in the job, the CFO walks into your office with a folder under his arm. He sits down, opens the bank's full balance sheet, and taps his finger on one specific line. You look at the numbers and your stomach drops. The bank holds $10 billion in customer deposits. Regular people, businesses, pension funds, all trusting that this money is sitting there, available, waiting for them. But in actual cash, immediately withdrawable, there's only $800 million. You ask, trying to keep your voice steady, where's the rest of our customers' money? The answer is the first big truth you learn about the entire banking system. Loaned out, invested, tied up in 30-year mortgages, in working capital for businesses, in long-term government bonds. The money people believe is sitting in some kind of vault with their name on the door simply doesn't exist anywhere physically. It's been multiplied, recycled, relent dozens of times over through a mechanism called fractional reserve banking. And this is, without exception, how every bank on the planet operates. From the most traditional community bank in your town to the largest financial conglomerate in the world. You just learned rule number 1 of the game. A bank never actually stores money. A bank manages promises. Level 3, the false sense of control. In the first few weeks, everything seems to run smoothly. Deposits keep coming in. Loans get paid on time. The spread, the difference between what the bank pays in interest to depositors and what it charges borrowers, generates steady profit. Month after month, you start to feel in control. You approve a larger line of mortgage financing. You aggressively expand the small and medium business credit portfolio across the region, energized by 12% customer growth in a single quarter. The numbers climb in the quarterly report. The board is thrilled. You feel like you've finally cracked the game. You haven't. You just haven't seen the part that breaks yet. Level 4. The weight of responsibility. 6 months into the job, the central bank announces a series of interest rate hikes to fight inflation, pressuring the economy. In theory, this shouldn't be a decision that affects you directly. You don't set the benchmark rate. You don't sit in a room where monetary policy gets decided. You don't vote on it. But your bank, like virtually every bank in the world, bought billions of dollars in long-term government bonds back when interest rates were low, chasing safe returns on excess cash. Now, with rates rising, the market value of those bonds is collapsing. It's basic fixed income math. When interest rates go up, the price of older bonds paying a lower rate goes down. On paper, accounting-wise, your bank still looks healthy because those bonds are classified as held to maturity, which means you don't have to recognize the loss as long as you don't sell them. But if for any reason you needed to sell them right now before maturity, you'd be selling at a loss of billions of dollars. You learn the second most painful lesson of the profession. Your business depends on decisions made by people you will never meet, in a room thousands of miles away. It's the exact same mechanism, at the exact same scale of risk, that took down Silicon Valley Bank, a bank sitting on billions in devalued bonds that nobody noticed until it was too late. Level 5. The first crack. A major client, the owner of a regional retail chain with more than 50 stores, needs to withdraw $200 million at once to cover an emergency cash flow gap in his company. Nothing outrageous about it. It's his money. He has every right to withdraw it. But to honor that withdrawal without draining your available cash, you need to sell off a chunk of the government bonds that are currently underwater. You authorize the sale. You booked a loss. Nobody in the market notices right away. The transaction flies under the radar for a few days. But an analyst at a local investment fund, reviewing the mandatory quarterly filings, spots the movement and publishes a short note saying the bank sold bonds at a loss to cover a liquidity need. On its own, that information isn't a crisis, but it lands in a group chat, local investors, and small business owners before it even reaches mainstream financial press. And in that group chat, the interpretation is instant. The bank is out of money. Level 6. The run. At 8 a.m. the next morning, the line outside the main branch already wraps around the entire block. It's not an angry mob, not a movie-style panic scene. It's ordinary people, retirees who depend on that account, small business owners who need to pay suppliers, families who've kept their savings there their whole lives, all of them wanting exactly one thing: their money back, right now, today. You understand, for the first time in your bones, what economics textbooks call a bank run. Mathematically, it's impossible to serve everyone at once, because their money was never all sitting there to begin with. It's spread across 30-year mortgages that haven't matured, government bonds that don't come due for another decade, working capital loaned to businesses that also can't pay it all back on short notice. The system you inherited, one that operates entirely within the law, following the exact same rules as any other bank in the country, is perfect, as long as nobody asks for everything back at the same time. And right now, everybody is asking. Level 7. The isolation. The banking regulator calls an emergency meeting. Regulators on one side, lawyers on the other, and your own board of directors, who just last week were praising you publicly for the growth in the loan portfolio, now asking in a very different tone why you didn't see this coming. In that room, you notice something cruel about power at the top of the financial world. When the bank was doing well, the credit went to the market, to a strong economy, to your strategic vision. Now that it's struggling, the blame is entirely yours. You haven't slept properly in 3 days. You run scenarios late into the night. An international investment fund offers to inject emergency capital, but demands 40% equity ownership and your immediate resignation as a non-negotiable condition. A larger competing bank signals interest in absorbing the customer portfolio, a polite euphemism for buying up the pieces after a controlled collapse, at the lowest possible price. Level 8. The impossible choice. You reach a crossroads with 3 paths, and none of them are good. First, accept the outside capital, injection, and lose control of the institution you swore to protect, handing over 4 decades of history to investors who only care about the return. Second, let the bank fail and be remembered forever as the president who sank an institution that had survived 3 previous economic crises before you ever walked in the door. Third, request emergency assistance from the Federal Deposit Insurance System, which solves the immediate liquidity problem, but publicly exposes on national news that your bank needed a bailout. And that's the kind of headline almost no financial institution ever fully recovers from, even years later. You choose the bailout. Under any cold, rational analysis of the numbers, it's the most sensible decision available. It's also, without a doubt, the most humiliating moment of your entire career. Level 9. The real cost. The bank survives. Depositors get their money back, guaranteed by the Federal Deposit Insurance System, exactly as it was designed to work in extreme situations. In the headlines, the story becomes just one more short paragraph about risk management, failure at a regional institution. Nobody mentions your name in the opening lines. Nobody needs to. You resign 3 months later. Not because the board formally pushed you out, but because, through this entire process, you understood something no finance course ever really taught you. Running a bank was never about keeping money safe. It was always about managing the trust of thousands of people in a system that, structurally, mathematically, cannot honor every promise at the same time. And once that trust cracks in public, it doesn't come back to normal no matter how many press releases get published afterward. Level 10. The cycle. A year later, you read in the financial news that another regional bank, in another state, has just announced its new president. Young, 33 years old, ambitious, coming off a solid career at an investment bank. At his inauguration interview, He smiles for the cameras and says that running a bank, at its core, is simple. You just keep people's money safe. He thinks he knows what he's getting into. He doesn't. If you've made it this far, you probably also like understanding what's behind businesses that seem simple from the outside. If you want to keep looking behind the curtain, subscribe to the channel and turn on notifications.